This is Chip Maxwell, and you're listening to the Retire Smart podcast with David Brooks. This episode kicks off with a sharp look at China's economic struggles and what plunging industrial profits could signal for global trade negotiations. David and Chip also unpack a surprising new directive considering cryptocurrency in mortgage lending, examine an overheated stock market through the lens of price-to-earnings ratios, and explore the global migration of millionaires toward more favorable economies. David, I do want to ask you about Bitcoin as mortgage collateral, but first I want to squeeze in a story. We want to talk about it the first segment, but we ran out of time. We're keeping a close eye on China, and the president announced recently, we have a trade deal. I don't think we've gotten any specifics yet, but meanwhile, maybe a deal has been reached because we have some increasing leverage. Here's a CNBC headline. China's industrial profits plunge 9.1%, steepest fall in 7 months. You've been saying for a long time, China needs us as much or more than we need China. What's going on here with the industrial profits?
Well, you quickly saw the tariff rhetoric, and companies stopped ordering stuff from China. And so China's in trouble here, right? They're industrial, and they are a big manufacturing nation, right? We've talked about Scott Bessent telling them they need to switch to consumption themselves. But what's interesting when you dive in the numbers, Chip, the privately held for-profit companies in China, and there are some, right? Their profits only went down like 1.4%, but the state run are down like 5 times that. That's where the loss was. So in other words, what it is the Communist Party is eating the losses, in other words, to try to negotiate and act like they're not in such pain. As we talked about, 1,800 factories closed in 1 month back in April. 1,800.
Boy, that's not sustainable, though. You can't keep that up forever.
No, and so again, and then we heard, Commerce Secretary Ludnick, run out. Hey, we got a deal, and then Bessett's like, well, it's not finished, and I'm like, I wish they would stop that, Trump-esque, if you will. Oh, we got a great thing, Just tell us the details for real when you have them, and let us analyze the data when we get it. But yeah, China is in trouble here, and they're hurting, and that's one of the reasons that you saw everything get pretty quickly hunky-dory after the Iran-Israel exchange and after we bombed Iran's nuclear facilities. There was threats, they're going to shut down the Strait of Hormuz, et cetera. No, all that oil gets sold to China now. That's where most of that oil is going, and China is no way going to let Iran shut down that strait. They need the energy flow coming to them to survive, and if they lost energy and trade with the U.S., China would implode fiscally, and it's in significant trouble. And again, I don't have his quote today, but I often cite Kyle Bass. He's the president of Heyman Capital out of Dallas. We talk about from the Big Short fame back in the day. But anyway, he talks in very in depth just how fragile China's economy is, and they are going to have to come and play ball. And so I hope Trump keeps a hard stance with them, because I think we end up benefiting. But it is still going to be some pain for us to go through here coming up.
Well, when we get some specifics on that trade deal, we'll take a look at it. Meanwhile, David, you sent the team. This is a memo from U.S. Federal Housing. This is the Federal Housing Finance Agency order issuing directive to consider cryptocurrency as an asset in risk assessments. This is dealing with Fannie Mae and Freddie Mac, the quasi-federal, home loan agencies. David, how can something as volatile as cryptocurrency be considered an asset for a loan, for a housing loan?
Well, let's see. If the housing market is locked up and the government is trying to find any little advantage to stimulate some activity, if you will, they might loosen the rules somewhere, right? Okay. And so this is just one of many facets with which they are trying to loosen the rules to get some stimulation in the mortgage business, to get people to buy and sell homes. Because without the housing industry going well, the economy usually goes south. And we've talked about it extensively over this first half of this year. Look at the listings creep up. I've been telling you this for 2 years. It would be happening, and now it's actually happening. I mean, I have a gentleman who no longer lives here. I walk my dog by his house every day. It's vacant. He listed his house, and I was like, little bit high. I mean, he'd bought his house only like a year and a half earlier, got a job offer to move back up to Minnesota, and now the house sits vacant, and I think he's overpriced by over $100,000. And lo and behold, one just sold down the street for about that price drop. Still no price drop. People are delusional at what they think their homes are at some point. They see the very peak and think, that's what I'm getting or I'm not selling. Well, then you may not be selling. Now, again, we are way better off here in Omaha, our housing market, relative compared to many places that I have lived. And in particular, Florida.
We've talked about it a few times on the show.
Yeah, I mean, I have a condo that my son lives in that I own, that he rents from me, one of my adult children, that's lost, I don't know, 12, 14% already this year in value on Zillow, right? So pretty significant drop. Now, I don't have to sell it. I have no plans to sell that. I don't have any debt on it. I can hold it forever. However, could you imagine if your biggest asset, which is the average American, the number one asset they own, Chip, is their home? If your asset drops 15% in value, how's that going to make you feel about spending money?
Well, you're going to tighten up.
Yeah, and so it's a psychological, right? So the wealth effect works on the upside and it works on the downside.
Okay.
And that makes the consumer tighten up. On top of that, we now have the average FICO score dropping almost 20 points month over month because student loan delinquencies are now being reported. And we have millions and millions of Americans struggling there. And then again, record credit card debt, record interest rates, and yet the market is at all-time highs. What a world we live in today.
David, you sent the team a chart, and you're going to have to take the baton on this one because this is one of those cases where I'm not exactly sure what I'm looking at. I'm looking at an equity index. I know that much. Break it down for us.
All right, so the chart here is showing the various indices. So the one in the center we're going to focus on is the S&P 500, most commonly followed index, 500 largest companies publicly traded in America. And so one of the things we talked about earlier, fundamental and technicals earlier in the show. So how many times are we willing to pay earnings? So if a company trades at $10 a share, Chip, and their earnings are $1 a share, what's the price to earnings ratio? That would be 10, right? 10 times the earnings. So historically speaking, the S&P typically trades, and on this chart you can see the range at market lows. Back in the 80s, it went all the way down to 10 times earnings, the example I just gave you, right? But historically speaking, we're 15 to 18 times earnings, with 17 being about the mean. The average, 17 times earnings. Right now, we're trading 22 times earnings, and not only outside the blue box, which is the norm of, you're going to have ranges, because when the economy is expanding, we're willing to pay a higher multiple. When it's contracting, a lower multiple. But the wick, if you see there where that dot is, that's the extreme highest of history. Highest all-time price for the market on a PE valuation, price times earnings valuation, which is the most common way that we measure the market price. It doesn't mean it can't go higher, though. I want to make that clear, because we get the, Alan Greenspan way back in 1996, irrational exuberance, right? His famous quote that came out of one of the Fed speaks talked about it. And the markets were pretty frothy then, and they ran double digits for 3 consecutive years after that until we ultimately ended up in the dot-com bubble. So I'm not saying this necessarily means the end of this bull market. It just means heed with caution, right? Understand the valuation of these markets, and maybe it's time to change the allocation. There's going to be some opportunity. In other words, Chip, right now bonds have gotten slaughtered because interest rates have stayed high. Well, eventually we all see interest rates going down, which means bonds will make you money. When interest rates go down, bond prices go up. There's also going to be an opportunity in small caps. They have gotten terrible return relative to the S&P 500 in the last 4 or 5 years. Same thing with emerging markets. So on the other side of this, there's going to be unique pockets of amazing opportunity to get return. But you must be proactive in looking at the macro data to understand how to change your allocation. And again, we had that question earlier, hey, I can do this risk management my own. And I often ask, when they sit in front of us, they say they do it on their own. What's your process for picking and buying? What's your process for selling? And they typically, most DIYers don't have a sell process. I know that's a lot to cover here, but anyway, rich market is the point here. It's very expensive, traditionally speaking.
For those listening on the radio, this would be worth a trip to our YouTube channel to actually see the chart, and then it all snaps into place. David, we're going to have to squeeze this in quickly, but Fox Business had a recent headline: U.S. expected to gain 7,500 millionaires in 2025, bringing $43.7 billion in wealth. This is people in other countries moving to the United States, David. The winners in this sweepstakes. Actually, the United Arab Emirates is getting even more, and then the United States, Italy, Switzerland, Saudi Arabia. The losers, the people seeing the wealth move away, the UK, China, India, South Korea, and Russia. I guess it's economics 101, David. You create hostile conditions for your millionaires and they may well leave. And if you create incentives for them to come, then they may come.
Well, and this is also benefiting us paying down debt via the gold EB1 Visa, right? The gold card that we're selling, right?
Yes.
For $5 million a pop. And exactly, if we make it attractive for capital flow here, it will flow here in a free market. Now, you want to see this on a microcosm? Let's talk about New York 1 year from now or 2 years from now. If the current Democratic mayoral candidate actually implements some of the things he's openly talked about on social media, you will see a mass exodus of high net worth people from New York City. But anyway, money flows, capital goes where it's going to be welcome.
Thank you for listening to the Retire Smart podcast with David Brooks. If you want to learn how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, visit retiresmartpodcast.com. And make sure to subscribe to keep up with new episodes every week.